Bitcoin is back above $70,000. After weeks of pressure, volatility, and heavy ETF outflows, BTC has reclaimed a major psychological level. And this time, the move isn't coming from hype, it's coming from macroeconomics. US inflation just cooled. Federal Reserve rate cut expectations are rising again. Institutional ETF flows are showing early signs of stabilization. And in Washington, progress on crypto market structure legislation is quietly building a foundation for long-term growth. But here's the real question. Is this the beginning of a sustainable recovery or just another relief rally inside a larger bearish structure? In today's in-depth Bitcoin legacy analysis, we'll break down why cooling US inflation matters for crypto, how Fed rate cut probabilities are shifting, what ETF flows are really telling us, why the market structure bill could change everything, the technical levels traders must watch, and whether 80K and 100K are realistic targets. Let's begin. What triggered Bitcoin's move above $70,000? Bitcoin rebounded sharply from $65,000 and reclaimed $70,000 for the first time in 4 trading sessions. The key catalyst? The latest U.S. Consumer Price Index report. Annual inflation fell from 2.7% in December to 2.4% in January, below expectations of 2.5%. Core inflation also eased from 2.6% to 2.5%. This may seem like a small difference, but in financial markets, small shifts in inflation expectations can change everything. Why? Because inflation directly influences Federal Reserve policy, and Federal Reserve policy directly influences liquidity, and liquidity drives Bitcoin. When inflation cools, the probability of rate cuts increases. Lower interest rates mean cheaper borrowing costs, more risk-taking, and higher asset prices, particularly in high-beta assets like Bitcoin. After the CPI release, June Fed rate cut probabilities jumped to 68.6%, up from 64.6% the previous day. That shift in expectations fueled immediate demand in crypto markets. But this isn't just about short-term price reaction. This is about the macro cycle. Why Fed rate cuts matter for Bitcoin. Bitcoin is no longer just a speculative tech asset. It has evolved into a macro-sensitive liquidity instrument. Historically, Bitcoin performs strongest when the Fed is cutting rates, liquidity is expanding, the US dollar is weakening, and risk appetite is rising. During aggressive tightening cycles, liquidity drains from the system. When liquidity shrinks, speculative assets struggle. Now we are potentially entering a transition phase. If the Fed begins cutting rates in June, we move from restrictive policy toward neutral policy. That shift historically supports equities, high-growth tech, emerging markets, and crypto. However, the Fed remains cautious. Chair Jerome Powell has emphasized that inflation must show sustained progress before rate cuts begin. That's why upcoming data will be critical. The U.S. economic calendar. Why this week matters. Several major events could influence Bitcoin in the coming days. FOMC minutes, Q4 GDP, services PMI, personal income and outlays, and core PCE inflation. Core PCE is particularly important. It's the Fed's preferred inflation gauge. If core PCE comes in hotter than expected, markets could reduce rate cut bets. If it comes in cooler, rate cut expectations may increase beyond 70%. Services PMI will also be crucial. If the service sector shows accelerating price pressures, it could contradict the CPI data. And then there's GDP. A weaker GDP print may actually help Bitcoin in the short term, because slowing growth could push the Fed toward easing sooner. So ironically, weaker growth could boost crypto. This is why macro traders are watching this week closely. ETF flows, the institutional puzzle. Now let's talk about ETFs. US spot Bitcoin ETFs saw $15.1 million in net inflows on February 13th. That ended a two-day outflow streak. But zoom out. The broader trend shows 4 consecutive weeks of net outflows. Major funds saw significant withdrawals, like iShares Bitcoin Trust, Fidelity Wise Origin Bitcoin Fund, and Grayscale Bitcoin Trust. Collectively, 6 ETF issuers reported weekly net outflows. This is important. They reduce structural demand, and they signal caution among professional money managers. However, daily inflows returning, even modest ones, could signal stabilization. If ETF flows turn consistently positive again, Bitcoin could regain strong upside momentum. Market Structure Bill. Why regulation matters. Progress in the US Senate on the Market Structure Bill is another bullish factor. Clarity reduces uncertainty. Institutional investors require legal clarity, regulatory consistency, defined custody rules, clear classification of digital assets. If the Senate passes meaningful crypto market structure legislation, it could unlock broader institutional participation. This wouldn't cause immediate price spikes, but it would support medium-term capital inflows. Regulatory clarity historically precedes adoption waves, and adoption waves precede price expansions. Fear and Greed Index. Extreme fear. Despite Bitcoin reclaiming 70K, sentiment remains deeply pessimistic. The Bitcoin Fear and Greed Index remains in extreme fear. Historically, extreme fear often appears near local bottoms. When sentiment is overly bearish, weak hands exit, leverage resets, selling pressure exhausts, smart money accumulates. But sentiment alone doesn't reverse trends. It must align with improving fundamentals. Right now, we see cooling inflation, rising rate cut probabilities, legislative progress, stabilizing ETF flows. This combination supports a cautiously constructive medium-term outlook. Downside risks. However, risks remain. One key global risk is Japan. If the Bank of Japan signals multiple rate hikes and raises its neutral rate toward 1.5 to 2%, US-Japan yield differentials could narrow significantly. This could trigger a yen carry trade unwind. We saw similar volatility in mid-2024. When carry trades unwind, liquidity tightens rapidly, and Bitcoin suffers. Other risks include hot US PCE data, persistent ETF outflows, delayed Fed rate cuts, and strong US dollar rally. If these occur, Bitcoin could retest $60,000. Below $60,000 exposes the August 2024 low near $59,351. That level represents a structural support zone. Technical analysis. Technically, Bitcoin remains below its 50-day and 200-day moving averages. That suggests the broader structure remains bearish. However, RSI shows oversold conditions. Momentum is stabilizing, and price reclaimed $70K. Key levels to watch. Resistance levels: $75,000, $80,000, 50-day EMA, 200-day EMA. A sustained break above $80,000 would invalidate the current bearish structure. That would shift the medium-term outlook decisively bullish. Upside targets then include $100,000 psychological level and previous all-time high near $123,731. Support levels: $65,000, $60,000, and $49,351.
If Bitcoin holds above $60,000 and ETF flows stabilize, medium-term recovery becomes more probable. 6 to 12-month outlook. Looking ahead 6 to 12 months, if Fed cuts begin mid-year, inflation continues cooling, market structure bill passes, and ETF inflows resume, Bitcoin could target a retest of its all-time high around $123,731. But if rate cuts are delayed, inflation re-accelerates, liquidity tightens, and global carry trades unwind, then Bitcoin may remain range-bound between $60,000 and $80,000 for several months. Bitcoin above $70,000 is significant, but it's not confirmation of a new bull market. It's a shift in macro sentiment. The short-term outlook remains cautious. The medium-term outlook is constructive but conditional. Everything now depends on US inflation data, Fed communication, ETF flows, and legislative progress. Bitcoin is no longer just a technical chart. It is a macro asset, and macro is turning.